good options trading strategy, which is known as call backspread. Many people have made videos on this particular strategy. However, it took me some time to find out the exact name of the strategy. Um, Many people have actually made videos on this particular strategy, saying that zero loss strategy and uh, zero loss strategy and whatnot. They also have made a strategy on ratio spread, things like that. So callback spread is this particular strategy, and if you are a positional trader, that means if you can hold on for a particular month or so, then this strategy can be really beneficial. Now I will be talking about what is this particular strategy and how it works, so what is the setup and things like that. And so the call back spread is also known as reverse call ratio spread. This is basically a bullish strategy in options trading, and it involves selling one quantity or multiple quantities if you want. So and buying two out of the money calls. Now, this strategy might sound confusing, but this is basically a very good strategy for positional option traders. So, whenever you actually look at a particular diagram, personally, I find it little bit confusing based on the payoff and things like that. So, how the construction of this particular strategy is: sell one in the money call, buy two out of the money calls. So what happens is, you can apply it in the other way also, that will be known as put back spread strategy. That's all. That's wholly different. But I have named it here as call back spread so that you understand. You can apply this in stocks too. However, you have to see whether there is enough liquidity or not. So if you are a beginner in options trading itself, you need to just go through the basics of to how what exactly I'm talking about. But this is the construction of it, and I'll show you an example. So, uh, so sell one in the money, two out of the money call. So I'm going to just show you from the Nifty option chain. And so I'm going to just take you to the Nifty option chain page and give you a small example as to how this strategy can be built. Now, this strategy can be done in multiple ways. If you have this strategy can also be applied if you have a neutral view on the market. That means you do not know which way the markets can react for now. Then you can actually apply in one direction only. I'm sorry, both directions. So you can make a call back spread as well as put back spread too. So I'm just going to show you call back spread just with an example so that it's clear to you. So this is the NSE option chain page. If you do not know about this page, I've made a lot of videos on this. I will probably try to make few more videos on it with few more updates based on my understanding. So, as you would see, this is basically the chain. This is the option chain for Nifty. Nifty is currently trading closed at around 10,876 in the December series. We are currently in December here, as you can see. So, as you can see, all the yellow shades here are in the money calls, and this side here are in the money puts. All right. So, the construction of the strategy, as you would see, that sell one in the money and buy two out of the money calls. So here is the catch, and that's the reason why I actually showed you. Sorry. So ideally, you can pick up any in the money levels here, strike price, and you can probably take 200 or 171 based on your investment and things like that. So what will happen is, for example, you constructed 332 here, 10,700 and 10,950. You can also take 900 calls. So what will happen is, if the markets will go up, this 10,700 will increase in one ratio. So this will be a loss. However, this will be in profit, the ones which you take, any of these. This is out of no money calls. So this will be keep on increasing into two ratios. So if for example, markets will increase from here. So this will increase in one ratio and this will increase in two ratios since you actually purchased two of these. All right. And then there comes a point where if keeps on increasing, this will keeps on increasing as one, this will keep on increasing as two, and then at a certain point you have to exit. But this is the strategy is built up in such a way that this is an unlimited profit strategy. So market reaches 12,000, this will be in the ratio of 2. It keeps on increasing to every 2 for every 100 strike prices here, and there comes a point, I think once it reaches somewhere here, or not here, basically once it becomes deep in the money, this will also increase with 1:1 ratio. So it will be, as I told you, this will be a huge profit once it reaches here. So so what happens the other way around? The other way around here is if it goes and crashes here, Nifty crashes and reaches till 10,400 here, then you will have limited losses. So that means this sell will be in huge profit. This will obviously will be in loss, but this will be in profit and you will have limited loss here. Now, how much will be the loss is a big question. So you sold the option for 332, for example, here, and you bought 171, two lots. So 340 would 342 approximately. So if Nifty expires at somewhere here, both these will expire worthless and you will actually have only 10 points loss, which is around 750 rupees plus brokerages and taxes. Sorry. So again, as I told you, if it goes here in the upside, you will actually receive, you will get unlimited profits here because that's how it keeps on growing. If it closes below 10,700, this will be both these options will expire worthless and then you will have only 10 points loss. What if it expires somewhere in between? That's when you would actually have some losses here. That would be again limited losses because this will still have value. This might be in the money and this will be out of the money. So basically this will be in profit. This will be in slight, I'm sorry, I think I clicked on it. So this will be in slight profit, but this will be in complete loss. So basically if you know that this is getting expired between this, you can actually square up the position, but there is a calculation based on how you will get the data, but you get the point here. Again, this is not a zero loss strategy. I have seen many videos and many YouTube channels which say that this is a zero loss strategy, and also many zero loss strategies. I have to tell you this honestly. Again, zero loss strategy. There is no zero loss strategy. Unfortunately, there is no zero loss strategy because if that there is one, then anyone would be able to make money. Again, there are a lot of some adjustments you have to make in every strategy for it to be profitable. You can you can buy and sell even this strategy also. That could be a zero loss strategy. But what if it Nifty reaches here? So again, what I mean to say here is markets can go either direction. And it is not the strategy, how you use the strategy which matters, which I always keep on emphasizing it, that it's not the strategy, it's the person who uses the strategy which matters. So I am here to, I keep educating you about how the strategy works, when you should apply and things like that. Yes, of course. So coming back to this strategy, when you should apply this strategy is this. This strategy usually applies in a volatile market, especially this time of the time December 2018. I think that this strategy can be applied at this time. That does not mean that it cannot be applied at other times. It just means that right now we are at a very crucial stage. There are a lot of events have been lined up this month, next month, in the coming months, and the markets, Indian markets, can be highly volatile, and there are very good chances that it would be highly volatile. And when there is more volatility, that means that you have more chances of making money. So call back spread strategy could be a good option strategy. You can actually do on both sides too. Somewhere here you can sell a put and then buy somewhere here two lots. One additional tip I would like to give here is try whenever you purchase, buy two options, two out of the money options. I'm sorry, they keep clicking on it. So two out of the money options here. It should not be more than the options which you're selling. For example, this is 332, 10,700 put. So the combine of, if you're buying two here, 145 plus 145, it is around 290. So this 10,700 and 11,000 looks to be a good setup, because in this way you are actually you are not losing anything. Even if markets expire worthless here, you will be in small profit but not huge losses, right? Same goes with as I told you. So if it markets goes up also, if it reaches here or here, then you will be in profit, because you have two options which you have bought. So that's just an additional tip. But if you still have any questions or clarification, you can just put in the comment or join my Telegram channel and personal message me, PM me there. So that's about this video here. I don't think I have missed out any points here. This works with Bank Nifty too, and also stock options. However, please do remember that this only works. You have to see in stock options. You have to see how much, whether the volume is there or not. For example, I'm just pulling up Yes Bank call. As you would see that Yes Bank stock itself is highly volatile, and you have to see whether volumes are there or not. So if you see that there is a huge volume here till 125, as you can see, not huge, but then there is volume till 150 here and now. What you need to do here is, you can't pick up a stock where the volumes are less. If the volumes are less, then it's that may not work well with you. So for example, here there may not be buyers or sellers itself. That time there is no point in selling this, because you will not get you will not be able to buy back. When you are selling an option, you have to buy back the square of the position. So that's exactly what I mean here. So that's exactly what I mean here. So that's the only problem with stock options, that volatility in the money options might be less. So this once it, for example, what I mean to say here is, if the you made this strategy with here 155 and 170, right? What happens is, the stock already reaches 200 or 225 or 230. This there will not be much buyers at this price. There will not be even sellers or buyers. What will happen is, in order to square off your position, you need to actually buy it off, right? So you have sold the position, so square off the position, you need to buy it, and there are no sellers available. And that's the only problem with the strategy with stock option. However, in Nifty, there is good volume in most of the stocks. So I'll go back to Nifty here, and as you can see here, the volumes are there even till well, even in 9,600 also. So in this way, as you would see that, I mean, there is a huge volatility there in here. As you can see, even there is a volume in 8,000 also. 8,000 put also. That is really almost 2,000 points, more than 2,000 points away. So 3,000 points, I would say. So that's my point here. So in Nifty, you will see volume. It's highly liquid. However, in stock option, you may not find this option. So that's pretty much about it. And the margin required for Nifty is approximately 50 to 60,000 to sell an option. When you buy two options, you might get a margin benefit. So approximately 50 to 60,000 would be your total investment for this strategy. Bank Nifty, the lot size has changed to 20 now, and then again you would you might require less margin for to trade Bank Nifty. However, yeah, again you can apply the same strategy here. Bank Nifties are also highly volatile in nature, and also they have weekly options too. So again, so you can apply this strategy. The strategy works perfectly when there is a big event coming up because you are not sure which direction it will go. Then it makes sense. If you buy a naked buy or a sorry, call or a put, there is a possibility of a premium decay. So that solves this problem. This strategy solves that problem completely. So if you know what is option writing and option selling, you would know what I mean here. Again, as I told you, if you have any questions or clarification, feel free to comment. I'll be happy to answer them for you. And also, if you have not joined my Telegram channel, please feel free to join. There is a link on the description below about my Telegram channel, and I do post regular updates on that channel, also the strategies which I'm testing at the moment. So thank you, and I will see you again on my next video.